Let's talk about behavioral risks and emotional bias. So this is something that comes up all the time. You know, people work at these companies and they've got an emotional attachment to these companies. They're unlikely to want to sell the stock because there's an emotional attachment there, Nolan. There's loyalty bias. There's what we call the endowment effect. So when you own something, you know, you consider it to have a higher value than it might actually have in actual fact. And then there's something called FOMO. We all know that word in just general parlance, but the fear of missing out. So a lot of people think, okay, well, if I sell my stock and then it goes higher, I'm gonna feel really awful about that decision. How do you deal with those types of risks that seem to come into play when we're talking about company stock and owning our own company stock?
Yeah, so this is all behavior modification. It's really hard, you're right, because if you're a hard-charging, successful executive, then you're pretty much all in on your company. You know, it bleeds through your bloodstream and you can feel it. And so it's really hard to separate the investment part from my love of, my dedication to, my affinity for. What I'm saying, tell investors, you must do that. You need an independent person with no emotional attachment to tell you if your company's a good investment or not.
That's
because
right.
you are a bad judge of that. Because you're in the corporate meetings, you know, well, we got this new product coming out and everybody's rooting against us, so it's us against the world.
Yeah.
You don't understand how hard, you know what I mean? So you have the inside view, but then there's an outside view, and generally what an investor's thinking about when they own the company stock is they're thinking about that stock and that company, but they're not thinking about the other 4,000 stocks they could own if their money wasn't all tied up in this one.